All right, so I'm not even going to exaggerate when I tell you guys you are going to need to glue your eyes to the screen, glue yourself to the damn seat if you need to for the next 10 minutes or so, because if you follow the option selling strategy I'm about to explain, you will make money this upcoming week if you're smart enough to implement it. I am not kidding. It's so unbelievable. This is literally like having a fucking hacked video game account where you just dominate every level and have unlimited money. And the best part is all it is going to require is 10 minutes of your time every Friday for it to work. That is literally it. It's not hard to understand, but unsurprisingly, I've never heard anybody on YouTube talk about this strategy, but don't worry because I am here to drop the sauce that actually works. Works so well, in fact, that strategies like the one I'm about to explain made me roughly $2 million in profit in 2024 alone, and I've helped hundreds of other traders make a F ton of money with strategies just like this one. And yes, I'll pop my account up on the screen for those of you who are thumbing away at a hate comment. But let's not waste any more time. I'm going to jump into what I call the 0 DTE CSP strategy. All right, let's do it. All right, so now we're on the whiteboard here and I'm going to cover the 0 DTE cash secured put. I'm gonna go through this from scratch, give you guys the basics of each step so you have an understanding of kind of like the theory behind it and then how to apply it in practice. So let's go over the name first because this kind of explains what the trade actually is. So the trade is a 0 DTE cash secured put. Now, what does that mean? So 0 DTE, if you noticed in the title, I put that we're taking this trade on Fridays. That's because we're gonna place the trade on a Friday, and since the option contract expires on Friday, it's gonna be a 0 DTE contract. And then we have a cash secured put. Now, if you're not familiar with what a cash secured put is, it goes as follows. So say we have a stock here that moves like that, and we sell to open, not buy to open like normal. We sell to open a put, right? So we sell to open the put, and say this stock is at 100, and we sell to open the 90 put, right? For selling to open this 90 put, we receive a premium, money to your pocket for entering that trade. And as long as our stock stays above 90 by our expiration, we collect that premium. So in this case, the 90 put that we sold would be expiring the same day, right? So it's 0 DTE. So in that one Friday, as long as the stock stays above our strike price by the end of the day, we collect that premium. Now, there's certain criteria that are going to make this juicy, right? Because we want, so typically, let's explain this first. So typically on Friday, right? So Fridays, you're gonna have low option premium, right? Because the theta curve is almost done, right? So all the time decay has been sucked out of the contract. So there's gonna be low premium on Friday because the most likely probability is that the stock is not going to go very much in either direction in one day. However, if you find stocks that have high IV plus a large move downward, right? These two conditions combined, high IV with a large move downward on that Friday or during that week, those are going to create higher option premiums, right? Because there's turmoil going on with that stock or with that sector of the market. So option premium is then going to be higher, right? Because IV, when IV is high, option premium is higher, and it's better to be a option seller. So let's go through a real life example of this to make it more clear, right? So we get that relationship. Now let's actually go through an example. By the way, if you guys are not familiar with option selling, you need to be. So if you are new or you're experienced and you want my option selling cheat sheet, or if you want me to just cram all this information into a 30-minute call, you can book a call with me on my website. You can click the link in the description. I've been talking to a bunch of you guys who have been having some unreal success. So that's really great to see. So yeah, hop in Option Lab if you want to. But anyway, let's get into a real life example. So the stock that I'm going to use today is APP, right? So this is App 11. So App 11, right? This is going to be a volatile name, right? It moves a lot in either direction. It always has a lot of news on it, and it's always swinging all over the place. So the chart, for example, might look something like this, right? Where we're seeing these massive spikes, massive drops, massive spikes by massive drops. Now, what we're going to do is we're going to ask ourselves, why would APP be a good candidate for the 0 DTE cash secured put? Well, on that Friday, so this is actually just this past week, App 11 had a massive drop downward on Friday. So it opened, I think it was 21 points down. So my logic was, since the stock dropped a ton, right? So the stock dropped big. This is going to cause implied volatility to be higher, option premium to be higher, plus this was an expensive stock, right? So the more expensive stocks have a higher option premium. So those three factors allowed me to place a 0 DTE cash secured put. So let's say, for example, the stock was at 480, right? At the open on Friday, right? So that's Friday. It opens at 480, and that's down 20 points from the day before. Well, now, if I sell a cash secured put 10 points below or 20 points below at 460, I think I actually did the 460s. If I sell to open 5 of those contracts at 460, and say that option premium is 3 or 4 per contract, that's an easy $2,000 to $3,000 in one trade. And the stock is already down 20 on the day. So the likelihood that it's going to drop another 20 simply by the end of Friday, which is that same day that I'm placing the trade, is highly unlikely. So I'm literally collecting free money for doing this. And even if I were to be assigned on that option, that cash secured put, I would be buying the shares at a steep discount because the stock is already down 20 points that day. So I hope this is kind of making sense for you guys, but the general idea, if I want to just wrap it up here in a few bullet points, is find stocks that, step one would be find stocks that dropped big, right? On Friday. Overnight Friday, right? Then 2, this is going to spike, IV is going to be higher, option premium is going to be higher. Then we're going to sell 0 DTE cash secured puts. And 3, if assigned, right, if the stock does go below our strike for that day on Friday, we write covered calls. And if you are not familiar with the wheel strategy, which would that then be pertaining to, hop in there and you guys can see kind of how I normally run this, but that is the basics of this strategy. I hope that is helpful for you guys. I made that one short and sweet. If you did find that helpful, drop a comment in the description. If you do want to hop on a call with me, click the link in the description, theoptionlab.com, and I will see you guys in the next one. Peace.